Our objective here is to equip bank and credit union employees with the skills and knowledge to identify, respond to, and report mortgage fraud effectively. This course will emphasize the significance of detecting and preventing mortgage fraud to maintain the integrity of your financial institution and comply with your legal requirements. Well, let's start here. Let's start with the definition of what loan defects are. Loan defects, simply put, are the inaccurate or false information contained in a loan application. Such defects can lead to significant problems, such as repurchase demands from investors, rescission of mortgage insurance coverage, and even lawsuits and some headline risk. So understanding and addressing these defects, plus the problems bobbing in the wake of these defects, is crucial to maintaining the integrity and stability of your institution. Let's talk about these red flags. And I'm going to start in kind of a weird place. I don't know how to commit fire insurance fraud. I don't know if it's significant if I did or did not replace that fire alarm in my house, or if I live close to a fire hydrant. I have no idea how to commit fire insurance fraud. So as I explain this to you today, and as I go through these things, if I sound patronizing, I'm not, believe me. I'm just explaining mortgage fraud to you with the same level of detail I would hope that a fire captain would explain fire insurance fraud to me. So if it sounds basic to you, just understand I'm trying to give you information in a way that I would hope somebody would give fire fraud to me. So let's start with this topic of what lies get told. First, let me say that fraud has a technical legal definition, but for our purposes here, just assume that it is an intentional misrepresentation. So what do people lie about? The main areas of concern for you as an employee of the bank are a borrower's cash, credit, debts, employment, and income, and maybe the value of the property. That covers the waterfront. There are other frauds like title fraud and wire fraud, but for this class, let's just stay in the loan application. This should make you feel better knowing that there are just these topics to cover and not 100 others. So let's talk about who, what, why, and how. How are you going to find these misrepresentations? How are you going to catch them? So let's talk about income misrepresentation. This is obvious, right? People misrepresent their income so that they can get a home loan. That's what they lie about and why, but let's talk about how they do it. Let's take a look at a couple of examples of misrepresented income.
Story time with Bob Simpson. Today we look at misrepresented income through the story of truck drivers and a crooked CPA.
One case that I had involved a defaulted loan for a home loan that was made to a truck driver. And when we took the loan apart and we looked at the tax returns that were in this guy's file, we found something very odd. We found that he had reportable income of about $35,000 and that he had taken about $50,000 in depreciation. He was driving a big rig, so he had this CPA prepare his Schedule C that showed he was taking $50,000 in depreciation. That's an odd thing we do in the mortgage industry. We let people add back as real income these, quote, phantom expenses of depreciation. Well, $50,000 boosted his income from $35,000 to $85,000, and poof, this guy becomes a homeowner. When a second loan from the same broker went into default, we started analyzing all of this broker's files, and what we found was about 10 different loans, all involving truck drivers, all with the same CPA preparing their tax returns, and every one of them was taking about a $50,000 bump in their income from added back depreciation. I think it's pretty clear that with a situation like this, you have insider knowledge. Not everybody knows that in the mortgage industry, you get to add back depreciation in order to help somebody qualify. And so in cases like this, you look and you say, do we have a sophisticated borrower? Do we have a CPA that's been doing this frequently? Or do we have a loan officer that's involved? In this case, it turned out once we interviewed the loan officer, we knew that he was working together with that CPA to get people qualified who might not otherwise be qualified. Let me give you a second kind of mortgage fraud that is out there right now. Miracle employment. Here's where miracle employment fits in. Your borrower comes to you, and the problem that the borrower has qualifying is a spotty employment history. They might have had 6 jobs in a couple of years, none in the same field. It's not a good employment history. There are some gaps. And so a month or two before they want to buy a house, they get a wonderful job that solves all of the employment problem. It's salaried, it's stable. What I've seen is $7,000 a month, for example, as a bookkeeper. So what the borrowers are doing is going to a relative. Let's just say our borrower is Bill, and he's going to go to his brother Jim and say, hey, show me working at your company for a couple of months. $7,000 a month, put me on payroll as a bookkeeper. Bill's brother Jim is happy to help and hires him basically for $7,000 a month. Pay stubs are real. Verification of employment is real. When a lender asks, are you employed? He can say, yes, I have a job. But the only problem is that the misrepresentation there is there's not going to be a possibility that a month or two after this loan closes that Bill is still employed. The only purpose of the job was to make sure that they could tell the lender that he's employed. And sure enough, as soon as the loan closes, Bill quits, and he's back to the same spotty history that the lender never would have accepted the first time they looked at his loan application. Let me give you a training hint here. In one case, I found that the fraudulent miracle employment was at an address owned by the borrower's boyfriend. Thank you, Facebook. Residential addresses of employers are often a significant clue. Now, Fannie Mae has recently moved to prohibit family member job offers, which I think is the proper reaction to this kind of fraud. However, the scheme remains viable if another party, say a non-relative, can be paid to play along. Recently, a real estate broker and a loan officer figured out how to falsify income by modifying court documents. Let me show you how that worked.
Savvy professionals. Fake child support orders.
The third and last fraud in this lesson is fake child support orders. Recently, a real estate broker and his loan officer figured out how to falsify income by modifying court documents, specifically divorce decrees that shows that a person is getting substantial amount of child support. We in the mortgage industry accept these court orders as proof of income, and it's not hard to fake. Where this particular pair got in trouble was using court-numbered cases that didn't apply to the court cases in this county, and it came undone. In all the cases that were looked at, virtually all of them, the child support was virtually the only income that was being counted towards the purchase, so there wasn't any other income that had to get faked. Unsurprisingly, when they did an investigation, they found that all of these borrowers were working through the same real estate agent and the same loan agent. This particular scheme had been successful for some time when Fannie Mae finally caught on and issued a warning about Northern California scammers trying to use fake child support. So what's the advice to avoid this kind of savvy fraud? Avoid silos. There's less chance of catching this type of fraud if you have everyone working in their own silos. Instead, in a group meeting, pose the question, does anyone have a weird file where somebody's wages are coming in from something other than regular work? Then you might find other underwriters have seen these players, these real estate agents, or this originator in their files. No, it is not normal to have a buyer with all their income in the form of child support. Sure, it happens, but normal? No. Get your people talking about abnormal files, and there's no quicker way to infuse your whole team with the wisdom of veterans than having these kinds of meetings. Occupancy misrepresentation is high on the list of common misreps found in home loans. Occupancy misrep is not viewed with the same seriousness in the real world as other kinds of frauds we face. I know it's a big deal to us because occupancy is important to loan-to-value, to rates, to mortgage insurance, to investor relations. But to the general public, it tends to just be considered a minor crime and no big deal. So you will find it is very, very common. Let me tell you a story. One time I brought a lawsuit alleging that a borrower had committed mortgage fraud, and my complaint alleged a lot of things, misrepresented employment and occupancy, and this borrower failed to respond to my complaint. So what you do in court is that you file for what is called a default judgment. You go in with papers to the judge and you say, I filed a suit, the defendant didn't play, and so please give me my judgment based on a default. Well, I was invited into the judge's chambers to get this default paperwork signed, and I sat there with this judge, and he read my complaint. The judge was Japanese American, and as he read my complaint of income and occupancy fraud, he put the papers on his desk, and he said, I'm going to sign your judgment, but Mr. Simpson, do you know that my grandfather in the 40s had to buy the family home through a straw buyer because Japanese Americans couldn't buy property in the 40s. And he signed my papers, but the message he sent me clearly was, don't bring this weak stuff into my courtroom anymore. This is not important to the real world. It was a sharp reprimand, and I don't think he was trying to send the message, but I've never forgot it. There are things that the public does not take as seriously as we take. And just because the rest of the world thinks it's no big deal, maybe that's why we find it so often. How many Airbnb and VRBO owners misrepresented their occupancy when they bought their investment property? I know more than once I found our subject property listed on Airbnb the day after we closed as an owner-occupied property. Was it a rental the next day? If it was, this was obviously misrepresented. So these are good examples of occupancy and income misrepresentation. That answers the question of what gets lied about and how it gets lied about. But let's talk about the why. It's important that you understand the distinction between fraud for profit and fraud for housing. Fraud for profit is generally associated with those kinds of fraudulent real estate deals where when the loan closes, there really isn't an intent to continue making the payments, or if there is an intent to make payments, it's got a limit to it. They might intend to make the payments for a year or so, but the purpose of that loan was accomplished the moment they got your money. Fraud for housing is different. That's somebody who actually wants into a house, wants your money to help them secure a place to live, and they intend to live there, but they might be way in over their heads. Two distinct problems. One loan, fraud for profit, where they really don't want to pay you back and they're not going to make payments, and the other one where people are going to try, but they might be drowning. Let me say a few brief words about what are occupancy red flags. You know, you look at a loan application and some things might jump out at you and you say, I'll bet that guy doesn't live there. What if you look at the loan application and the place of employment is 150 miles away from this house? I have questions about whether the guy is going to live there and work over here. I've seen some strange examples, so you can't just assume that someone doesn't live in the house because they're working far away. Let me give you an example. I had a matter where the person's employment was 100 miles away, but when I called and checked, the guy was a drywaller, and he was driving all over Arizona building homes. So it really didn't matter that he lived a long way away from his employer. So it's a red flag. It'll give you a thread to pull, but it is not conclusive just because they live a long way away. Let me give you another red flag. You look on the schedule of real estate owned on the loan application, and there are 5 different properties. Is he really living in the least expensive, smallest property that he owns? I'm curious about that. Or if you have a property that is what I say near sand, you are in Palm Springs, California, you're on the coast, you're in Florida, and it's obviously a beach town, are you living there, or is that your getaway? So you look at these things as red flags. They aren't conclusive, but they give you a thread to pull. You will find attached to this course my list of common red flags about occupancy misrepresentation.